Welcome back to Citi Market Watch. This is episode 8. The goal of the series is to give you meaningful updates on the market and how this impacts your investment strategies and portfolios. Welcome back, Audrey Cheong, Citigold Private Client Portfolio Manager. Audrey, what's top of mind right now?
Hi, Sun. Well, it feels like a cage match with Andre the Giant while Mike Tyson is chewing your ear off. The only thing clients are talking about is China. Regulators have crushed the education sector. The after-school tutoring market has seen a 65% sell-off, and there are now growing concerns that further regulations are going to stifle growth in e-gaming, e-commerce, and even healthcare.
It does feel like carnage. China's market indices have effectively given up all their gains for this year. And given the strong performance from last year and the earlier year-to-date highs, the drawdown feels like a nasty pileup on the CTE with more than a few indiscriminate casualties. Audrey, what's driving the government's actions?
Well, regulators have cited antitrust and social equity issues as their key motivations for these actions. In the case of Ant Financial last November, it was going to be a record-breaking listing on the Shanghai and Hong Kong exchanges at $34.5 billion, but the IPO was pulled last minute as regulators were concerned over regulatory oversight. Now, Ant Financial grew commercial loans over its platform from 500 billion RMB in 2017 to over 1.7 trillion RMB by 2020. In terms of anti-monopolistic practices, even JD took Alibaba to court, which it won with a favorable ruling in 2019. Now, from unfair pricing, consumer rights, tax, and platform exclusivity, China regulators have seen the need to ensure a healthier competitive environment. Ant Group was fined 18.2 billion RMB and now will look to operate as a financial holding company and hence come under more checks and balances similar to Chinese banks.
Thanks, Audrey. Somehow the phrase all care and no responsibility comes to mind. Given the incredible reach of Ant Financial or Ant Group, it makes sense that more of its balance sheet should be at stake. In addition to regulatory oversight, as with any other bank or financial institution. Moving to the crackdown on education or after-school tutoring, this has been a brewing issue for many years, with after-school tutoring costs running far ahead of income since 2013. The stress on low and middle-income families is quite astronomical given the over $40,000 price tag per child, as was reported in the South China Morning Post. Children themselves are also being overwhelmed with hours and hours of extra high-intensity tutoring. Regulators did institute rules back in 2018 when the Comprehensive State Council investigation declared its guidance to the industry. That is, guidance on training time, qualifications, licenses, facilities, and so on. But the impact has only been felt now with the latest ruling requiring non-profit conversion of K-12 tutoring and strict limitations on foreign investment in such entities. As we highlighted in previous digitization episodes, digital learning is still growing with up to 50 to 60% of daily study hours globally and in China expected to be digitized in the next 3 years.
And without a chance to catch a breath, a strongly worded article in the state-run newspaper, the Economic Information Daily, stated that video games were akin to spiritual opium and electronic drugs. And the article sent investors looking for the exit signs across e-gaming and other tech-related sectors. And now China tech has lost well over $1 trillion since mid-February. For context, the education sector is roughly 3.7% of China's GDP, whilst technology's reach across industries is approximately 40%. China has been down this road of thinking it can successfully nationalize industries, and any such effort to put a noose around its most vibrant sectors carries disproportionate risk to China's economic priorities. It is also important to be curious and ask why. Is it coincidence that a significant part of this drawdown has been directed at sectors that have listed as ADRs in the US? Sun?
Thanks, Audrey. Well, there are two acronyms to note here, VIEs and ADRs. VIEs are variable interest entities and ADRs are American depository receipts. VIEs were popularized by Enron for those old enough to remember. As special purpose funding vehicles, Chinese tech companies have favored these structures to raise capital because it facilitates foreign funding but avoids actual ownership of licenses that foreigners are prohibited to own under Chinese laws. The attraction of ADRs have always been the deep and liquid US capital markets. No surprise, as political tensions have risen between China and the US, much criticism has been laid on the lack of transparency, real ownership, and accountability across VIEs and ADRs. To be clear, ADR shareholders of Chinese companies have no direct voting rights nor clear jurisdiction in the case of major disputes. In December last year, the US passed the Holding Foreign Companies Accountable Act, which essentially targeted Chinese companies and requires them to be audited by US auditors, or rather the Public Company Accounting Oversight Board. Failure to do so would force Chinese listed companies in the US, ADRs, to delist. After a century of humiliation, this is an unthinkable scenario. It is understandable and important that the Chinese government controls this narrative and ensures that the direction of Chinese companies is dictated by the Chinese government and not the US, especially if it's within the context of social equality and stability. Audrey, how should investors be thinking about the onshore and offshore markets?
Oh, this is fascinating. So as you said, we will see many Chinese companies rethink where they find funding, and ADRs will certainly be less attractive. The net effect is we will see more listings in Hong Kong and the domestic China A-share market. We have seen the A-share market perform much better, and this is very much a reflection that A-shares are dominated by consumer discretionary, consumer staples, industrials, healthcare, technology, but also a much greater breadth across market cap, with micro caps, small caps, mid caps, and large cap companies. A-shares overall represent the wider opportunities across China, and given their very different institutional and retail, foreign and domestic composition, A-shares offer a very uncorrelated returns relative to the rest of the world.
It is surreptitiously exciting. We have been highlighting across previous episodes Citi's core unstoppable trends: digitization, renewables, healthcare, and the rise of Asia. Across all these trends, it is very clear that China is a pivotal leader, a key manufacturer, and adopter. Which country is the major manufacturer of solar panels, wind turbines, and lithium batteries? Which country has the largest installed capacity for renewable energy and is installing at the greatest pace? Which country has the highest levels and growth of e-commerce? The Chinese market has weakened due to heavy regulation across education and comments across the e-gaming and tech sectors. But don't let this distract from the amazing growth and achievements elsewhere and across the economy. Audrey, for some balance, could you comment on the fallout we have seen in the corporate bond market?
China has been enforcing greater financial discipline across capital markets and deleveraging across the property sector. It has instituted its 3 red lines, requiring property companies to meet certain financial tests by June 2023. As a result, there have been a couple of high-profile corporates or unsecured bond issues that have come under stress, and this has seen the asset class getting sold, especially as headlines have appeared saying that default levels are at historic highs, with approximately $30 billion worth of bonds having defaulted this year. But this is relative, as $30 billion still represents a fraction of China's almost $12 trillion bond market. China and Asia continue to have one of the lowest default rates in the world, lower than Europe and US, with significantly positive real yields.
Thank you, Audrey. This all feels pretty intense, but we hope we have shed some light on this market stress and reinforced the strong undercurrents propelling Asia and China that we can't lose sight of. Thank you for tuning in to this episode of Citi Market Watch and for your continued support. For more opportunities, please contact your Citigold or Citigold Private Client Relationship Manager.